2, 1. I think we are go, Jace. Hello, everybody, and welcome to this week's edition of Self-Wealth Live, the technical analysis edition. We're back after a week off, and it's exciting to be back because even though I was on holiday, it was a great little holiday up in the Gold Coast, and back down here in the freezing cold weather of Victoria. But it's good to be back in front of our viewers and being able to help people, in this share market world, in this investing world. Jace, how are you today?
Hey, Rog, all good here. Great to have you back, and good to hear you had a good time on the Goldie. And good show in store for today, hopefully.
For sure. Thanks for waiting, everyone. So we had a few, once again, technical difficulties, just like my voice right now. I think I'm still in holiday mode a bit, but we did build up a bit of suspense because we do have an exciting offer from Self-Wealth coming up very soon, which I'm going to announce. It's already in the terms and conditions. I'm sorry, it's already in the YouTube description if you want to have a look at down there anyway. But I will talk more about that. Thanks, everyone, for your tickers straight away. I can see them all coming through. I'll talk more about that after the disclaimer, please. Jace? Thanks.
Yes, of course. Everything we do today, general commentary only, no personal advice. And I'll put up that disclaimer that we look at. And I'm also not part of Self-Wealth. My business is Motion Trader. So my details are at the top, licensing, etc. And beneath there's a Self-Wealth disclaimer, licensing, general commentary, all that stuff we've been through is all in there.
All right, fantastic. Okay, so as everyone know, or current viewers know, what we do on this show is we basically go through the three major markets that we offer at Self-Wealth, and that is the Australian market, the American market, and the Hong Kong market from a charting perspective and the indices, using the indices, obviously. And then if there's any general questions, we'll go through them as well. But the main part of the show is about analysing the tickers that come in from the viewers. Now, over the 2 years, we are celebrating our sort of 2-year anniversary, which we did our show a couple of weeks ago. It was our 2-year anniversary show. And I've got an exciting offer to talk about. So, but before, if there's any new viewers, we're accepting one ticker from everyone. So if you want to put in your ticker, we'll try and do as many as we can, but we'll do one to start off with. And if you put in a couple and we have time, we may be able to circle back to the other one as well. If you're a new person in this show, we were going for about an hour and a half, and I think that's a long time for most people. But we're going to try and always keep it to about an hour this show, so you guys can get back to what's the most important thing, and that is investing and trading, right? So, but hopefully you can learn a lot, and that 1 hour is impactful enough. All right, now to the offer. You can see there's some terms and conditions in this description. If you're an existing Self-Wealth client, you would have got an email around this as well. Being our 2-year show, what the offer is, what our gift is for existing clients, is that if you email in, I'm going to say a special code word very soon. Obviously, it's just to sort of try and see if you're watching the show. All right. The code word will be, actually, it's a very famous investor. He's been in the markets for 30 years right now, and he's actually sitting right next to me over in Sydney. And that code word is Macintosh, right? So Macintosh. You can use that code word. Now, if you're an existing Self-Wealth client, all you have to do is email sales@selfwealth.com.au with that Macintosh code word. All right. I'll receive these emails. So, and you'll get 20 complimentary trades valid for 6 months. All right. So that's my gift to you. I've been able to organize that, which is great. Thanks to the team at Self-Wealth for putting in the hard work there and getting this promotion going. All right. So once again, existing clients, and it's valid for one portfolio only, right? So valid for one portfolio for existing clients, 20 free trades, valid for 6 months. So feel free to jump in using that code word Macintosh. Send an email to sales, and just put in your Self-Wealth portfolio ID, so I know which ones to credit the trades to. If you're an existing viewer, a new viewer, and you don't have an account with Self-Wealth, obviously to take advantage of this offer, you will also have the ability to get 20 free trades, right, valid for 6 months, but you would have to apply for an account first. Okay, there's a link in this show, in the show notes, as there always is down the bottom, on how to apply, or link to apply feel free to apply using that same email address. Once you've applied and once your account is open with us, I will then be able to credit you with those 20 free trades valid for 6 months as well. So it's all driven through that sales@selfwealth.com.au email address, and it'll be me having a look at it all, and hopefully hopefully it'll save you on brokerage for 6 months at least, using those 20 free trades, right? Just to make note, this is a limited offer, so it is valid for the first 20 existing clients and the first 20 new clients as well. All right, so the first 20 existing clients and the first 20 new clients that come on board, and valid for one portfolio for each of those clients as well. All right, I hope that's clear. If there is any other questions, then you can pop them on the chat, and I'll hope to answer them along the way. But other than that, Jace, I'm excited to get going. Obviously, RBA interest rate decision today, so nothing moving that much at the moment. But let's have a look at that Australian market, eh?
Yes, so let's do that. Let's over to our charts, and starting off with the ASX 200. And look, as you say, Roger, there hasn't been a lot of movement, and also there hasn't been a lot of movement really for the last 4 weeks, really. But look, having said that, I think the movement that we have had has generally been positive. So what we've got, prices continue to find support along this 50-day moving average. Below there, we've got the 100-day moving average. And whenever there's been a down day, so there's been a few quick down days within this 4-week period. Whenever there's been one of those down days, there's been a tendency for the market to quickly bounce back soon after. And so that's a sign of the dip being bought. And that's classic bull market price action. Prices, like going to an earlier period, prices run, they pull back to the moving averages, and they run again. And I think the odds favour that sequence continuing in current time. We've spoken about the potential for a longer consolidation over the last few weeks, and I think that's still the case. So yes, it's encouraging that the dip appears to be being bought, but until we see signs of that momentum off the lows, so for example, like 2 or 3 strong up days in a row, signs of that momentum coming in, I suspect it's going to take a bit more time for this market to consolidate. Of course, it could run at any time, but I think our base case should be expect some more consolidation in the days or maybe weeks ahead. The pullback from August all-time high, well, this is now the longest consolidation since the April low. So the previous mark was during June, July. Prices consolidated for about 6 weeks. And now this one here is just that little bit longer. And I think the latest consolidation, I think it's constructive. Big moves as we've seen from that April low. Big moves need proportional consolidations. And without those regular pauses and the consolidations, a trend tends to become unstable. So I think this is potentially a constructive thing that we're seeing. It's those pauses along the way that create the new support zones, which then often become the platforms for where higher levels can eventuate. Speaking of support, I think a level to watch in the near term is this one here through around 8,600. You can see this blue horizontal on the chart, and that takes in 2 previous highs. So the high from February, the high from June, and then also some consolidation through August. So I think this is a good level to keep an eye on. It also coincides around with where the 100-day moving average is. And I think it's an important region. And while it holds, this remains a relatively shallow consolidation, which of course is good. It's something we talk about often, shallow consolidations. And I think this has the potential to pass through maybe within like a couple of months of the August high. Maybe there's some further backing and filling above support, and then that could create that platform for higher levels. I think that's the way we want to be approaching this. Quickly looking at the equal weights, the ASX 200 on an equal weight basis, and it continues to outperform the ASX 200. So unlike the ASX 200, which has come back to its 50-day moving average, the equal weight continues to trade above the 50-day, and it's even hit a new all-time high last week and is just edging towards one as we record today. I think this shows the broader market's holding up well. And as we often discuss, a strong broader market is one of those key factors in a sustainable bull market. So overall, when we look at the ASX 200, coming back to the ASX 200, I'm viewing this as a pause within an ongoing upward trend. There are signs that we could be in for some more consolidation, but I think that underlying trend, I think it remains up. The moving averages are still rising, prices generally above the moving averages. And as always, though, having that exit strategy in mind for when conditions change. And for me, that's using those wide trailing stops, giving my winning positions room to move around, but having that line in the sand for when things do at some point reverse.
Yeah, look, it's always good to see that equal weight, holding up, and we're not just reliant on those big cap companies. Always great to see that coming along there. Hopefully, we can continue. Let's have a look at the US market, also sort of treading carefully.
Yeah, so coming over to the S&P 500, and last week it made its 28th all-time high for the year, and that's been followed by a pullback over the last few days. At this stage, I'm viewing this pause in the trend. Well, it's not really much of a pause at the moment. It's only a few days, but I'm just viewing it as a pause in the trend. Nothing stands out to me as being a warning sign of any impending trend change. Just looking at this underlying structure, the key factors I'm watching are the rising moving averages, the 50-day, the 100-day moving average. They're both continuing to trend higher. Price, of course, is above those moving average. So they're bullish markers. And also the clear sequence of rising lows and rising highs. From where things are at the moment, the pullback that we're currently seeing, to me it seems similar to what we saw during July. During July, August, and September, we've had these relatively short pullbacks. I think this could be another one which is like that, and they've of course led to further highs, not lasting tops. And when we consider the key factors I just went through, so the moving averages, price above moving averages, rising lows, etc., I think the odds favour new highs later in the year. But of course, that doesn't mean we should be expecting all-time highs every week. The potential for we could see a multi-week consolidation. I think that potential is very much there. That's where the market chops sideways, maybe lets the moving averages catch up. It's always keep in mind, it's been a big rally with only these short, shallow consolidations along the way. So if we get something which lasts a few weeks, I think that would be quite normal as well. Also, I want to show you what's going on in the equal weight on the S&P 500 side. So just having a look at this, and what we've had here, after trading sideways for much of September, it quickly came back to the 50-day moving average last Thursday. I don't think this damages the overall trend, but it's a sign that the broader market maybe isn't ready to move higher at the moment. So we have had this. While the S&P 500 has generally been moving higher, the equal weight's been treading sideways for maybe around 6 weeks now. Retest of these moving averages are normal in an uptrend. We've seen them many times in the past. You just come back to last year and you can see there's multiple tests of the moving averages on the way up, and that's just the way markets tend to work. Rally, pull back to the averages. So this in itself is nothing unusual. I think ultimately this consolidation can resolve with higher prices. But until we see the equal weight hitting these new highs, breaking above the highs from earlier in the month, I think it's a case that US stocks, maybe they're in for some more consolidation as well along the moving average. But as I said with the ASX 200, it's the underlying trend that determines my positioning. And we've got the rising moving average at this point. So as it stands, I think the trend remains upwards. And until I've got good reason to do otherwise, I want to stay with this trend for as long as possible.
Yeah, always great to hear the fact that, once again, it's the underlying position you have in the market is reliant on what you see and the trend that you see, and not being nervous around that, but rather having the confidence to hang in there and continue with the trend, right? So that's a really important factor.
And that's always the way on the way, like, they call it the wall, climbing the wall of worry. It's like you look at all these pullbacks along the way, and like some of them sometimes can be sharp pullbacks, but the underlying trend remains until you get that price action occurring below the moving averages, and that's when that's when you start looking for more concerning scenarios. But while price is generally above the moving averages, people get worried every time there's a pullback. There's always a reason to be concerned, but big trends, they have a habit of enduring for quite a while. So I think we should, rather than being pessimistic that a trend's about to end, I think we should be optimistic that a trend is going to extend. But then, of course, we use those risk management strategies around that, because sometimes they don't extend, they top and they come back, but we can have a plan for that. But whilst that overall structure is positive, I think the plan should be to run with it, see how far it can go.
Okay, fantastic. I like that, Jason. Very poetic as well. Let's have a look at the Hong Kong market.
Okay, over to the Hang Seng over in Hong Kong, and prices have been consolidating over the last couple of weeks. But look how that consolidation has been playing out. It's again, it's one of those shallow pullbacks. Prices made a high and then a shallow pullback, and the market has held on to most of its gains off the September low. So from September low, strong rally, shallow pullback. That's I think that's constructive. And as we often discuss, shallow consolidations are positive, as it's a sign that buyers are stepping up to buy on the dip. I think it's a case of being positioned for more upside in the Hong Kong market. And then when we go over to the Chinese market, it's a similar story here. Prices are making new highs, and well, they've been moving. So that has had a marginal high yesterday, but then that follows the highs from earlier in September, where prices have then largely gone sideways over the last few weeks, probably since mid-September. And that's really just been allowing these moving averages to catch up to the share price, as we often see in rising trends. And I think what's also been impressive is that the Chinese market has continued to hold on to its gains. So it wasn't long ago, Rog, that prices would rally, would get these rallies, and then those rallies would quickly give way to retests of the low. That hasn't been happening since the April low. Every rally, it's held onto those gains and continued to move higher. So that's a change in the way this market's been behaving, and I think it's a change in a positive sense. I think that again, that's a sign of bullish price action. So prices are also starting to get through this resistance. You can see this blue horizontal in here comes in around 15,000. So if I just compress this, you can see where that comes from. It it goes all the way back to 2015. So it's been a couple of three important tops. It's been a support at various points, as well as ongoing resistance. And so this is the longest. You look at these earlier examples. This is the longest that the market's been able to trade around this resistance area in the last decade. I wouldn't call this a decisive breakthrough at the moment, but it is starting to edge above this resistance, which has proved to be so tough to get through since 2015. I think this is a market with more upside potential, and like the Hang Seng, I think it's about being positioned for the further upside.
Okay, fantastic. All right. Well, we've already got a whole bunch of tickers to get through today, Jay, so we might end up going 2 hours today. No, I'm just joking. But it's not many general in there, not many general questions. But let's get cracking on some tickers. Let's start with Grant. Hi, Grant. We'll have a look at VUL, please.
So we looked at this. Must have looked at this a couple of weeks ago, because I've already drawn the some lines on here. So that's we would have spoken about that being a bullish wedge, and prices have broken out of that wedge, and they've had the nice run. The moving averages have turned higher. If I was in this stock, I'd be staying in it, be using my nice wide trailing stop. My exit point would be back down around the 100-day moving average, giving it lots of room to move. But if I wasn't in it, I'd be hesitant to chase it now because it now has stretched above the moving averages. And now be a case of, well, waiting for the next consolidation, see what it looks like. Do we get a sideways move while the moving averages catch up? That could create a buying opportunity. We kind of need to wait and see how the price action plays out. But yeah, as I say, this would be one I'd be happy to stay on board. See where it goes. It's a nice breakout from a nicely formed structure.
Fantastic. Tim, hi. Let's start with your first one, please. DVP.
And it's been a it's a largest pullback now. Let me just measure how deep that is. So I know this has been in the motion trader portfolio. I'm not sure whether it's triggered the exit. If either it has or it would have come very, very close. So this is a great trending move, but this has been an oversized pullback at 33%. It's like very much on the larger side of a. So I'm using an ATR based trailing stop. Let me actually just put one on. So an ATR stop, it works using a stock's recent trading ranges or volatility, and I find them better than a percentage-based stop because they can they adjust to a particular stock's characteristics. And just putting this one on, and so look, so a motion trader signal for this, or a signal I would have been looking at, I would have waited for the moving average to cross. We've had a downward period. Moving averages crossed back in October, but then we didn't get a 70-day high, so that wouldn't have been a buy for me. Then they've crossed again, and we've got a 70-day high. So I would have had an entry. This would have been a motion trader entry back in February. And the wide trailing stop, well, as we can see, so far it's stayed above there. So even though it's a big pullback, this is a stock I'd still be staying with because it was a look at the trading ranges on the way up. There's some big days there, and that's why you end up using a wide trailing stop to try and see off the pullbacks. So if I was in this one, I'd be staying in it. It's above an ATR stop. It's still above the moving averages, so it's potentially this is potentially a basing phase that it's going through, and it does have that potential to run up and make new highs. I'm just thinking, would I be buying it here? I'd probably hold up buying at the moment. I'd just like to see it re-establish itself above the moving averages. And so if we were to get some sideways trading above the moving averages and then another break higher, then that could produce a new entry point. And then a stop for that could be just back below the 100-day moving averages. So possibly a relatively close stop. But that's dependent on getting the right sort of price structure over the next couple of weeks, if we can just see this stock establish itself above the averages. But yeah, I think it's particularly if someone was in earlier in the year, I think this is still a stock which is worth staying on. The overall trend is still up. It's been a tough corrective period, but that's why we use wide trailing stops to try and see them off.
Okay, fantastic. So just remembering we're going through one ticker for everyone to start off with. So Roberto, NMG, please. N for Nelly, M for Mary, and then G.
Oh, this is just a nice upward trend at this point. And it's been an upward trend which has been, there've been opportunities to get on board. I think we've spoken about this one before. Like we've had the rallies and we've had this well-formed consolidation into the moving average, low volatility, which is unusual for like one of these low-price stocks. Like it was a one cent stock. They can move around quite a bit, but this has been a steady sideways move, then another break higher, which produces an entry point, then another sideways move and another break higher, which produces an entry point. If I was on this, I'd be staying on it, let the trend run. I'd hesitate to buy it up here. In fact, I wouldn't buy it up here because, like, where do you put your stop? So looking at the current price, like even to have a stop, back under the 50-day moving average requires 30%, 40% to get below the 100-day moving average. I think you need at least a 30% stop for me to consider this, and that's probably getting a little bit more than I'd want to be doing. I'd be waiting for the next consolidation if I was interested in this stock, but if I was on it, I'd be letting it run and I'd have my trailing stop. Well, I'd use an ATR stop like I just showed you, but it would be below the 100-day moving average. I'd be back, I'd be risking giving back this latest up move to stay on what could be a much, much larger trend. It's interesting seeing where this stock's come from. It's come from much higher levels. So look, I think it's certainly got more upside potential in it. One I'd like to let run if I was on board, but one I'd be waiting for the next consolidation to consider getting on board if I wasn't already there.
Okay, fantastic. It's good to see some new names coming along today, Jace. Maybe you've been before, but hi, Tim. Let's have a look at our stock of the year, maybe even last year. Was it DRO? Obviously trending okay at the moment.
Yeah, and making new highs yesterday, I think. And new highs again today. Again, this is a motion trader stock. Like, I know it was a new high yesterday because there was another motion trader signal for it yesterday. It's been signaled like a number of times since around April. We've got a string of new signals to get back into Drone Shield. And look, if I had Drone Shield, I don't have it this time around. I had it on the last run up, but I don't have it on this run up just because of the order of signals when they appear when I've got capital. So I don't have it this time round. If I did, I'd still be holding it. I'd be using the wide trailing stop. This was an interesting period through into the September low. That's a 33% pullback, and we looked at a 33% pullback with DVP just a few stocks ago, and this is why we use wide trailing stops. So a lot of people like to use their 20% or say 15%. Like there's one large broker that has a maximum trailing stop of 15%. So if you're using that, well, it's going to be hard to stay on a lot of these trends. Other people like 20% or 25%. And whilst it is giving stocks a bit of room to move, when you're on a more volatile stock like Drone Shield, 33% stop, 33% corrections are they're part of the personality of the stock. But the wide trailing stops, the ATR based ones, can help see them off. Let's just put it back on this one. And you can see it's still well below the current share price, but it sees off these big pullbacks. So I'd be staying on this if I was on it, giving it lots of room to move and just see how high it can go. It's I'm sure people thought, okay, look, the show's over when it got to 412 in July and started to pull back, and then it ran again, then it pulled back again, and then people think, oh, look, maybe that's it. But now it's at a new high. So we just don't know. You don't know how far these trends are going to go. Maybe it's getting close to running its course, or maybe it can run for many more months. You don't know. So I think it's wide trailing stop, let it run for as long as possible. If there's a really big profit, like say someone's in at $1 and it's now at $4, there's nothing wrong with taking a little bit off the table. Maybe sell a quarter, maybe sell a third, just reduce maybe just dampen that portfolio volatility by reducing the weighting of a very large position of a very large profit. But from a general perspective, I want to let my profits run, maybe take a bit of profit, but let a core position run.
Okay, great. Some great examples of being able to use that ATR stop to really keep you in these positions rather than stopping you out earlier, right? So that's good to see. Hey, Brendan, let's have a look at ASN, please. And thank you for the praise.
Yeah, this is the thing with these low price stocks. As I was saying, they can be volatile. They often are volatile. Like that's a 40% pullback, which is probably getting to the outer marker of what I'd be able to like sit with some of these stocks. But again, and it was a hard one to get on as well. Like, this isn't a stock I would have been able to get on. So by the time the moving averages had crossed, the share price was up at 10 and a half cents. I would have been saying, like, if we'd been looking at it just after the moving averages crossed, I would have been saying, look, it's stretched above the averages. It requires too large a stop to get on board now. So I'd say, I would have been saying, look, wait for the next pullback. So to get on this one, it's really a case of someone had to be preempting the low or getting on the bounce. And I would have also said, by those, I would have said, look, I don't want to buy whilst it's below the moving averages. So this isn't one which I would have been on. Looking at it now, well, we've got the pullback to the moving averages, but now it's pulled back some more. I'd just be watching it at this point. If I had bought it earlier and I was still holding it, well, I could continue to do that. I'd probably have my line in the sand below the September low, saying, look, if it breaks that, maybe I've just got to walk away. Probably give it a little bit of a margin, maybe just below 7 cents would probably be my stop for this one if I was on board already at lower levels. If I was looking at it now, I think I'd need to see it stabilize around the moving averages. So, like, can we see it stabilize a bit, form a base, and then start to break higher from that? So that's like, we get that bit of a base, and then we start to get a break above there, break above some recent highs. That could be an entry point. So then be rallying off the moving averages, and then the risk could be controlled, and we're completely making up this price action because we don't know what we're going to get. But if we did that, then we could have something like a 25% trailing stop, buying the breakout from the range and have a stop just below the maybe a low which is going to form. But of course, we're just guessing to what could happen. So I think this is one we've got to just come back and revisit as the price action evolves. So for me, it'd be sit and watch if I'm not in it. If I am in it, I can probably give a little bit more room, but I don't want to see it really breaking this recent low and then start getting below the moving averages, because then it risks potentially coming all the way back to where it started, as some of these stocks are inclined to do.
Okay, fantastic. Now, hi, Kay. I'm not 100% sure which stock this is, but we can start with URE. Let's have a look. This went up 50% in the last 2 weeks. I'd like to add more, but it's too stretched above the moving averages. Does it or does it not matter because there's momentum? Good question, but I don't know. Is it that second one, or is there one on the ASX or one on? Looks like
it's a TSX. So I'd be guessing if there's anyone, it'd be this TSX one we're watching, and the energy-based one rather than a ultra real estate.
Let's have the second one, the Canadian one. It's on the Canadian Stock Exchange, is it?
It's just a little bit more obscure for some people to trade the Canadian exchange. What are we saying, that it's up 50% in how long?
Yeah, it's been up 50% in the last 2 weeks. I'd like to add more, but it's too stretched above the moving average.
I don't think this is it. It's this is up quite a bit, but it's not up 50% in the last 2 weeks. Look, if I was on this one, it's one of those textbook upward trends, rising moving averages, higher lows, higher highs. But I'd be letting it run. I probably wouldn't be adding to a stock which is getting stretched above the moving averages. I'd be waiting for the next pullback, because the problem with say we buy some here as prices are starting to rise, and then we say, okay, let's add some more here. Let's just then say that gives us an average price. I'm just making some rough stuff up. Let's say that increases our average price to here. So when you get in down at this lower level, well, look, we're comfortable having our stop loss back here below the 50-day moving average. No problem. We can let it run, keep the stop loss down here. We're in the money. There's no problem with that. But as soon as we start adding to a position and our break even is at this higher level, which is still above the moving average, should the price then make its way back lower, it might still be corrective from the sake of a corrective perspective. It's still above the moving averages, but we're now running at a loss. So then people are saying, look, I'm just below break even. I'm going to cut this one. And then you find that it stabilizes and makes its way higher again. But because you've been adding to a position and increasing that average price, it becomes harder to hold that position when you get a pullback. So I think people have just got to be careful when they're adding that the average price doesn't get too high. I want to keep my average price lower so I don't feel pressured with my stop loss in a pullback. I want to be able to see off pullbacks. That's critical. You can't stay on a drone shield with 33% corrections if you're always adding and your average price is increasing with the share price. It's going to be emotionally, it's great when it's running. Emotionally, it gets very difficult when you're below your average price. So just something to be mindful of with that adding strategy. It's great when it's working, but the money's made by staying on trends, not getting shaken off during the pullbacks. So whether this is the right stock or not, I think that little run through would be just as applicable.
I think it's a great run through. Do you want to just quickly touch on UCU? Let's have a look at that one because I think it's that one there, UCU.
I'd be so hesitant adding. It's just like let's put on another indicator and see what we get. This is show the percentage above the 50-day moving average. So we can see this stock. Let's run a line across. So it's currently about 88% or close to 90% above its moving average. Let's run a marker across. We can see this has happened a couple of times before in recent years. It has been 90% or so above, but each time it's then come back towards the moving averages. Let's go back a bit more in time, and we can see other times it's gotten up to here's a good example. Let's focus in a little bit more on this. Run this across. So that's 90%. So this is one which had been running for a bit. And of course, the price action is never going to be the same. It's always going to be different. So it's not to say this is going to unfold like this. But maybe we're looking at something like around where prices are at this point here from 2009. They got to above. They had a pullback. What sort of pullback was that? That's a 35% pullback from being about 90%, 100% above the moving average. There's a 33% pullback. That gets to what I was talking about with that previous example. Can you hang on, or does it raise your average price to a point that you get shaken out during the 33% pullback, and then you miss the next run up? It's just an example of where we just want to be careful with adding. This is it's historically stretched. There's nothing to say that something can't make a new historical mark, and that it can't go to 150% above its moving average, for example. Nothing to say that can't happen, but we do know it's at a point where it's that risk of heightened downside volatility is it's certainly elevated. So I'd be wary about adding. I'd rather add after a consolidation when prices start to regain momentum, rather than after they've been running. It just brings in that extra element of risk. Personally, if I was in at lower levels and my stock was up a couple of 100% or whatever, I'd be happy with that. I don't need to keep adding, because then you've got to also think about what weighting does that stock then have in a portfolio. So if I buy a stock at $1 and it runs to $4. That stock now might be a 6 or 7% weighting within my portfolio. Do I want to keep adding to it and make it a 10% weighting? Well, no, I'd be more inclined to take some off the table and make it a 5% weighting, because I know at some point there will be volatility in it, and I can just reduce my portfolio volatility by having it not this huge weight within the portfolio. That's the thing with pyramiding. A position will naturally become a more prominent position within a portfolio. It's great if it doubles and triples and everything else, but when it gets volatile and it quickly comes back 40%, you're going to notice it in the portfolio most likely if it's an extreme weight.
Okay, some great points there. Hi, Simon. A bit of a question here. I would be interested to hear your perspective on the balance between market cap values of gold miners such as Barton Gold. Let's have a look at that. And their confirmed ore reserves and extraction costs. It's probably a bit of a loaded question for us, but yep, let's see what you can comment on that.
Look, that's a long done measure of value of mining companies or like gold stocks. You look at the resource. What's the resource? Or you get the market cap divided by the resource, and you work out how much per ounce and everything. You've got to be an analyst who specialises in that sort of thing. It's not something I do. You've got to take into account like what's the cost of mining. So, there could be a reason you're paying a premium for one, and another one seems cheap, but it's cheap for a reason. So it's not something I do. I'd rather just focus on the price action. I understand price action. I'm not a fundamental analyst who specialises in mining stocks. Look, for me, if I was in this stock, I'd be just letting it run simply because it's running. I'd be hesitant to buy it because it looks stretched and it may consolidate. I've been talking about gold a bit in my weekly strategy sessions as well about why there could be cause for some caution with adding to stocks at these levels. Certainly letting positions run, but do we extrapolate what we've seen in the last 6 months into the next 6 months? I think that would be a brave thing to do. Anything can happen. We just spoke about extremes can become more extreme, but we also don't want to get euphoric after a big move because that often leads people into trouble. For me, I've got gold stocks which are doing well, I'm happy to let them run. I'm not taking profit in them. But I'm also not coming in each week going, I'm doing so well in gold, I'm going to keep buying. So now at some point there'll be, there'll be something like this on the chart. Not saying it's going to be next week, but it will happen at some point. And we keep going buy. There's going to be an unpleasant day where we see a bit of red on the screen. So I'm comfortable letting profits run. Not getting crazy excited after big moves have been in place and prices have become stretched.
Okay, very good points. Hi, Yuki. Let's have a look at BHP.
It's an interesting one. So I've got this line. I've had this here for a while. A resistance point, kind of edged above it in August, came back, having another go at it. Moving averages are turning higher. It's we're starting to see like rising lows, which is positive, but it's not a standout within the mining stocks at the moment. I think it's BHP's could certainly turn into a good trend. Like it's really had this long sideways period for a few years. At some point, I think we will see this extend higher and make new highs. Is it happening now, or is there more consolidation? And I don't know the answer to that. I've looked at it to buy it a few times recently, haven't done so. Like it's interesting looking at the so BHP's got plenty of copper exposure. The copper miners are doing well, so that's a plus for BHP. The iron ore price has been interesting in that, like, is iron ore starting to try and turn higher? It's gone from below the averages to above the averages have crossed. So could this be the early stages of a revival on iron ore? So then that's potentially positive for BHP, Rio, as well as Fortescue. So I think there's some interesting things going on, but we don't have that real breakaway momentum in the share price as yet. I think, like, say we were to just get a little bit more consolidation around the moving averages, and then from there a punch higher, I'd be saying, okay, look, we've got it gone from below to above, consolidation along the moving averages, now a new high. It's go time for BHP. Just probably need a little bit more price action around it, a particular type of price action, like maybe like this sideways consolidation, to set it up. It looks close, but I just don't have the feel for it to say, okay, now's the right time. But I think it's getting close. I think it's worth watching. I look at it quite a bit. I think there could be a good opportunity to get into BHP.
Okay, fantastic. G'day, Kirby. Let's have a look at CU6, please.
Well, I'd be leaving this one alone at the moment. It's it's made its way back above the averages, and the averages have crossed, but then it's had this rapid pullback, deep pullback to the averages. How big is that pullback? 42%. So had I bought it as it was rallying, it'd be like, and I don't think I would have done that, because I would have been saying, look, it's getting a bit stretched. Let's wait for the next consolidation. But had I bought during this latter stages of the rally, it's 42%. Like, well, I would have been out. So I'd be out of this stock at the moment. So I wouldn't have a position here. It's back above the moving averages. I think what we need to see, it establish itself back above the moving averages. That probably needs some more price action. It needs to stabilize around or above the averages, build that new base, and then break higher from there. And then we can say, look, there seems to be some momentum building. At the moment, it could just as soon as come back down and retest the low, or oscillate either side of the moving averages. Or this could be the first move down. We've had a bear market bounce, and it continues to work to the downside. There's scenarios which don't look great at the moment that could play out. So I'd be happy just to watch this one, see if it can stabilize. If it can stabilize, break to a new high, great, let's give it a go. But if it pulls back below the averages and wants to spend more time oscillating either side, I'm happy just to sit back and watch. So for me, not just yet, but nonetheless worth keeping an eye on.
Okay, fantastic. Hi, Maddie. Let's have a look at RAC. I've seen this sometime in the last few weeks. Someone's been asking about it. It's I think viewers will be able to guess what I'm going to say with this. If I had it, I'd be holding it. If I didn't have it, I'd be staying away, because it's too stretched above the moving averages. I can't manage the risk around it. It's 40% to get below the 50-day moving average. So I can't buy it here and place a reasonable stop. So I'm better off just leaving it alone. But if I did buy it as it was breaking high, and for someone keeping an eye on it, aware of the stock, that was possible. It rallied, pulled back, and then started to break higher again. So there was an opportunity to get on board. A volatile stock nonetheless. But yeah, look, I'd be happy to let it run. But I don't too hard to get on board at this point. Like, just looking at like what it's done in the past, it's like, well, like even these big runs from the past, it does have the pullbacks towards the moving averages. So that's what I'd be looking for now. Like next, you get those initial rallies, but it does come back to the moving averages at some point. That's probably the point I'd next be able to consider it at some point. This whether it could push higher again, but at some point it is going to revisit this 50-day moving average, whether it be somewhere below the share price or at a higher level. That's when we can have another look at it. Okay, fantastic. Hi, Russell. Let's have a look at DGL, please.
This is an interesting setup. So it's been a stock which has been down and out for a while. I'm just looking at this period from late last year and the current period. So what differentiates those? So they're similar in that they went from below the averages to above, consolidated along the moving averages. So from below to above, consolidated along the moving averages. Where they differ is that this time around prices have broken to a new high, whereas last time they didn't. They weren't able to break break higher and trigger a signal. Instead, they continued down. So this, for me, would be worth consideration. It could probably be bought at current levels. So it's had that initial move up. It's just come back today. There may well be some more consolidation, but this could be managed with probably a 15 to 20% stop, something like that, like 15 to 20% around the 50-day to a bit below the 100-day moving average. So if it were to give back that, so it's had that nice gain over the last few days. If it were to give back all of that gain, it would sort of negate that bullish momentum. So that's why I think the exit point, the stop loss, could be around the 50-day moving average. But if it can hold those gains, consolidate, it could set up for another push higher. If I was in it, I'd be happy holding it. If I wasn't in it, which I'm not, I think it could be considered as a stock to buy if it suits what people are after. So yeah, definitely a setup worth having a look at.
Okay, let's have a look at Cat from John, please.
Well, this has been a terrific trend. So I've got some of this. I've had it for a long time. Can't remember when I got in, but I'm way back down here. It's a motion trader stock as well, and the original motion trader entry could be back in mid 2023. I'm thinking the original motion trader entry is probably from around July 23 at around $1 something. It's now up around $6. Yeah, look, letting profits run. It's not a stock I'm rushing to buy because I've already got it and I don't add to positions. Like, it's already become one of the larger positions in my portfolio just through natural growth. So no, I'm not going to go and add to it. If I didn't currently have it, well, I wouldn't be buying it at the moment because it's pulling back. I'd at least want to see it stabilize. But I do struggle to buy stocks which are already up hundreds of percent. Particularly with such a clean move with no consolidations, no lengthy consolidations. It's had consolidations, but they've only lasted lasted 3 months sort of thing. Look, happy to let this one run, see if it continue to push higher. Moving averages are rising. Wide trailing stop below the 100-day moving average. The wide stop's done a good job at seeing off some decent pullbacks so far. That's how I've got here by having the wide trailing stop. That's how I'll continue to approach it and see if it can do a bit more still.
Okay, fantastic. Hi, Stephanie. Hopefully there's a lot of ideas coming there for you. Obviously, we can't recommend any safe buying options. I don't think there's anything such as safe, but there's plenty of ideas coming through there for you, Stephanie. Thank you. Blue, thanks for the praise. Let's have a look at BGL.
Yeah, you're right, Rog. There's nothing safe in the stock market. The stock market's it's prone to volatility. That's just the nature of it. Even for someone buying an ASX 200 ETF, the ASX 200 can at times pull back by 30, 40, even 50%. So, and that's like got the biggest 200 stocks. The same when you look at the S&P 500 or whatever index it is. It's the stock market is prone to those periods of volatility. So it doesn't mean that it has to be high risk, but we've got to be prepared to accept volatility, or it's probably not going to be the place for us. Yeah, I don't think anything you could call any stock safe, because any stock you can think of has had volatility at some point if it's been listed for long enough. So BGL, let's have a look at that. Well, this is all a bit crazy here. So it's not much data. It's a recent listing. Look, I'd just be leaving this one alone. It's not much data. It's been, even if we take out this highly volatile initial period, it's below the moving averages. There's not much for the moving averages to calculate because it hasn't been there for too long. It's like, I don't know anything about the fundamentals of the company. All I've got to go off here really is it's been in a downward phase. It's had a bit of an upward burst over a week. It's a constructive. It looks like the dip's being bought, but I think where it's getting really into the realms of having a bit of a punt rather than going off a structure. Look, I couldn't even suggest that. So, like, even buying at current levels and having a stop below the recent low, it's still 33%. It's a lot of risk for not much price action. It's like, yeah, I just have to leave this one, unfortunately.
Okay, fantastic. Let's have, well, not so fantastic for that stock maybe, but let's have a look at Devenders, please. BFG, please.
I've had this stock in the past. I don't have it at this point. It's
Sorry, can we look at PFG? I made a mistake. PFG.
Okay, price action's a bit better here. Actually, it's a lot better. So looks like it's fairly thinly traded. You can tell just by like all the dashes and dots on the chart. But it's generally a positive structure in that. So we've had an upward phase from 2000 into 2022. Then we've had this large sideways phase, and it looks like it's starting to break out from this sideways phase. I wonder whether we could kind of like highlight the side. Oh, you can do a downward trend line, and doesn't really line up at the bottom, but you can still see nonetheless. You kind of got, you can see how it's kind of, you can see how it's moving sideways, and you can see how it's broken higher in recent times. I've got a bit of a breakout. It's gone sideways. Moving averages are catching up. If I had some of this, yeah, sure, I'd be happy keeping it. If I'd bought the breakout, I'd be happy staying in there, having a stop loss down around, maybe having a stop loss down around 22 cents. That's only about 10% away or so. So, relatively low risk from a percentage perspective. It could be considered at current levels, but it's thinly traded. Well, I'm pretty sure it is based by the look of it. So that's not going to appeal to probably a lot of people. But I think there's some potential with it. I think there's potential to see this continue to push higher.
Okay, fantastic. Just as we approach the 1 hour mark, we've got a lot of signals, a lot of stocks here, Jace. So I'm going to put the pressure on you to go faster if you want.
Okay, let's go.
I'm happy to stay. It's up to you. All right, let's have a look at the next one from Alexandra, sorry, and that is ASX.
Okay, so let's just I'll try really ripping through. So I won't, often I pause and I give more commentary around. I just try and move quickly so we can get through a bit. So I'm sorry if I can't give every stock the due commentary it probably deserves, but the interest in getting through a few more stocks. And this is just a no at the moment. It's got declining moving averages. It's making new lows. It's had I bought some as prices looked to be breaking higher earlier in the year, and they did. There was a legitimate case for buying ASX. It's not working now. So this is a stock. If I had it, I'd be looking to move it on, and I certainly wouldn't be buying it at this point. And if I did, if I wasn't moving it on now, I'd be having a plan in mind to where do I say enough's enough, because I don't want to hold a stock which is trending down open-ended.
Okay, fantastic. Andrew, please. Vulcan, great momentum at the moment.
We looked at Vulcan earlier on?
We did. You're right. Okay, Vulcan was right at the start of the show, Andrew, so you want to replay to that part. Ray, CYL.
Upward trend in place, moving averages look good, price above, new highs. Look, I'm probably not rushing to buy it at the moment, but if I had it, I'm very much holding it. I've got my trailing stop below the 100-day moving average. See where it goes. Give it room to see off pullbacks like we've seen in over the last year. They're like decent percentage pullbacks. That's why we need wide trailing stops. That's what's been working. That's what I'd continue doing.
Okay, let's have a look at KAR.
It's like the oil price itself is not giving us a lead at the moment. We don't have momentum either way. Oil just continues to wash around up and down. I'd be leaving this one alone now. It showed some potential. It looked like maybe something was building. A few months back, we had that nice rally above the averages, pull back to the averages, but then it all started to come apart in September. It's broken below the averages. Now we're getting that consolidation below the moving averages. So if I was still holding this and I wanted to give it a little bit longer, I could probably say, look, line in the sand might be below the September lows, but it's not a stock I'd be buying at this point. Before I'd want to buy it, I'd need to see it back above the moving averages, established above the averages, and then another push to the top side. That's going to take a bit of time for that to happen. So it's one I'd be leaving alone for now.
Thank you. Hubert, EVN.
Yeah, I've got some of this. I'm happy to stay with it. Trends up. As I've already said around gold, I'm not rushing to be adding gold exposure at this point. But yeah, look, this is a nice upward trend. Moving averages are doing the right thing. It's with gold, I've got core positions and I've got more tactical positions where I'll have the wide trailing stops. The core positions I've held for years and years. But this is one where I've got a core position and a technical position. So both I'm happy to let run. And but again, I think a wide trailing stop's a must. Motion Trader's got the calculator stop for it, and it's going to be below the 100-day moving average.
Okay, hi Evangeline. Let's have a look at DRE.
Happy to stay on a trend like this. A 1 cent stock that goes to 4 cents. That's where I'd consider maybe like taking a quarter or a third or whatever it may be. It's they're always hard, these stocks. You can just see this one's form in the past where it runs, it gets stretched, it does come back to the 50-day moving average at some point. This is also why I wouldn't want to be adding. Like, I don't want to be adding up at the point where it's just getting maxed out and it does come back to the 50-day. Not to say that it's happening here, but it could. It could be getting maxed out again and come back to the 50-day. So that's why I'd be hesitant to add. Well, I wouldn't be adding. But if I had a position, particularly if I got on early, it was a tough one to get on board because it went from below to above and just rocketed. But if I did get on early, yeah, look, and if I was up several 100%, I might put a little bit away now just to reduce portfolio volatility. But I'd be keeping a core position, letting it run, wide trailing stop. My stop from this one would be back down near the 100-day moving average. I'm risking giving a lot back. But as you can see in the past, you've got to have any chance of staying on a bigger move. You've got to have a big stop. Otherwise, you get washed out in those pullbacks. So yeah, it'll be an interesting one to keep an eye on.
Okay, thanks. Hi Sydney. Let's have a look at Bravura, which is BVS. Sorry, BVS, I believe.
Sideways consolidation. Is it starting to break higher now? Possibly. So they had a good, nice run for earlier or much of last year. It did quite nicely, and you can just see the consolidation through here from the high, and then we'll just oscillate either side of the moving averages, and now we're hitting a new high. So if I had it, happy to keep it. If I'm thinking about buying it, where is it at the moment? It's currently around here. So it's broken to a high, but now it's pulled back. So what I'd be inclined to do would be maybe rather than buy it today at current levels, I might say, look, okay, so traded higher and it's quickly come back. Maybe buy it on a break to a new high above today's high. So just another couple of cents above today's high. So at least I'm going with some momentum. Alternatively, maybe we see it, so it's gone from below to above, and that could be enough just to exhaust it for the near term. It might need to like chop sideways, and then from there we get more momentum. So then I'd be looking to, if we get that sideways pattern, buy the break above that. If the moving averages catch up, it could be buy it on the moving averages. A few scenarios could play out. We don't know what it's going to look like. I'm just hypothesizing on what we might see. But that's how I'd play it at the moment. If I didn't have it now and I wanted to get it, I'd wait for now and see what price action develops, or maybe buy a break to a new high. But yeah, one where I think there's some upside potential.
Okay. Hi Betty, SNL please.
SNL, I've got some of this one. It's look, the moving averages have turned lower and it's below the moving averages, so there's definitely a point of vulnerability. I've had this one for ages. It's been a motion trader stock for a long time, back to 2023 or something. So I'm up several 100% in it. The motion trader trailing stop, I don't know exactly where it is offhand, but it's probably down maybe around the $30 mark. So I'm prepared to give this a bit longer. Just because a stock gets below the moving averages and the averages cross doesn't automatically become bearish. It becomes vulnerable. So there's a difference between being vulnerable and being bearish. Bearish is when, I don't really have a good example here, but bearish is when, when something's continuing to make new lows below declining moving averages and you've got a trend in place. So that's a bearish phase. At the moment, we just could be in part of a corrective phase. So it hasn't turned from corrective to bearish at this point, but there's vulnerability there. So I don't want to buy it. To buy it, it's got to get back above the moving averages, re-establish above the averages, and then break again. So there's a bit of time before I think I could consider buying it if I didn't have any. But for now, I'm happy to just hold what I've got, watch that wide trailing stop of triggers. Well, it's been a great trend. I'm happy to give a little bit more back for the potential of staying on it if it runs again. But I want that line in the sand because I don't want a situation where I've ridden it all the way up and then over the next 2 years I ride it all the way down. I've seen that happen many times. That won't be happening with me because I've got that calculated exit point, which I know where I'm out. So let's see whether it can get a foothold here and get back above the averages.
Okay. Hi, Jennifer. First of all, thank you for the MAU gold. It's up 20% as of yesterday, which is great. But she wants us to look at BHM, please.
VHM, is that right?
B for Barry.
Oh. BHM. It doesn't show up properly in this chart. There's been this gap down here. I think there was some sort of a capital return, or there's some corporate structure change. Something's happened with this gap, and I can't make it disappear when I click the adjust button. So looking at this, you'd say, well, no, the moving averages, moving averages are still in a negative position, but it has recently been a motion trader signal. So for that to happen, the moving averages have to be upwards. So it's not a chart I can really interpret properly with the price action not being adjusted correctly, I don't think.
Can we have a look at sorry, I'm just going through. Is it BMH, Jennifer? Okay, she's just changed.
No,
it.
Broken Hill Mines would be the one because
Okay.
I have recently seen a motion trader signal for BHM, but it looks different on the adjusted data which I have when I look at it through my system software than I'm getting on TradingView. So I'm not sure. I don't think this is the adjusted price action. Nonetheless, if we just do look at this last little bit, it's even if this was the correct price action, it's gone from below the moving averages to above, and the averages are turning. We've got a series of rising lows. I think there's a play here, but I can't talk you. Look, I won't try and talk through this chart because I'm thinking of something which you can't see. So yeah, we're probably best leaving this one.
Okay, Shumita, let's have a look at ATV, please.
Yeah. from below to above the averages. I like the consolidation sideways while the averages crossed and started to move higher, and now we've got this secondary breakout. So I'd be happy if I had some of this, letting it run, see where it goes. Could we buy? It's like it's one of these low price ones, so they're prone to volatility. Like, where do you put it? Even at current levels with it consolidating, it still kind of needs like almost a 40% stop. So I think it's a harder one to buy. It's like, unless you just go, look, I'm just going to have a stop below those recent lows, and put say a 20% stop on, but you got to do that with the knowledge that you're prone to intraday volatility that could trigger a stop, and whilst it's still consolidating above rising moving averages. So like we saw in this phase here in August, pull back and then it dipped lower and then shot back up again. So they're just harder from a risk perspective. But the price action does look encouraging. Rising lows, looks like we've got that breakout. If it continues to chop sideways for another couple of weeks and these averages move up, maybe we can address where to place a stop loss around current levels. But it's certainly one I'd be happy holding for a speculative position. I'm just finding a little bit difficult to think, where do I get in at this point? Or is it buying a break to a new high? If we buy a break to a new high, we're still looking at around a 30% stop. So you've got to be comfortable with that wider stop to give it reasonable room to move.
Okay, let's have a look at LDR.
Was it VR or DR?
LD, D for Derek, and then R.
Okay, it looks like maybe we've got a base in place. We've got an initial rally off the base and a pullback to the averages, and then another rally. So it seems to be like stepping higher. If I had some, I'm happy holding it. Don't want to buy it at these levels because it's stretched. So then now it becomes a case, if I'm looking to get in, it's a case of like, what does the next consolidation look like? And if I'm in it, it's a case of having a trailing stop, which is wide enough to potentially see off a consolidation. So I'm probably looking at a trailing stop, which is down around, maybe down around 17 cents, down around that 50-day moving average, giving it lots of room to move around. Because as you can see, like just looking at this pullback, there's a 40% pullback. If you want to stay on these lower price stocks, you often need to give them lots of room to move to potentially get the big gain. But then, but then also remember, a lot of them don't. A lot of these stocks don't turn into the next big thing. There's some excitement, and then they come all the way back. So you've got to have your exit point in mind. There's some terrific gains to be made in the low price stocks, but the price action can be fickle, and many of them don't go on to greatness. So you've always got to bear that in mind when you're playing it down this highly speculative end.
Okay, fantastic. Hi, Ben. I missed yours. Let's have a look at EGG. EGG.
That's it. Look, it's just, unfortunately, this is just a no. It's like we've got these declining moving averages. Price tried to break higher in July, but just looking at this, we wouldn't have got a motion trader signal through this, because by the time the moving averages crossed, it didn't make a 70-day high. So that's why, like, I use a 70-day high in combination with moving averages for this very reason, to try and avoid false entries. So the 70-day high is like an extra confirmation of momentum. So moving averages cross, prices above, but they don't trigger a new high. So it's a stock I wouldn't have got into. And if I was in it now, I'd be thinking, well, look, I've probably made a mistake. I might need to just cut this and protect my capital. Yes, it could go back up, but it could also go back down, could continue down further. It's below the averages are crossing, so there's vulnerability. So I'd be wanting to protect capital rather than hoping for a return of capital at this point. And if the price action changes, if it gets back above the averages and starts doing the right things, I can always look at it and come back in later on. But at this point, I'd be moving into a defensive position.
Okay, fantastic. The next one is Let's have a look at TLX.
Downtrend. This is a downtrend. This isn't a consolidation. It was consolidation up to around June, where it was having some time below the moving averages. So this is where it was. This is where I'd be saying there's vulnerability, but it could still be corrective. And then we've got the sharp move below the previous low and then the low from April, and that's where it becomes bearish. So at that point, it was for me, it would have been a walk away moment, and nothing's changed. It yes, it could. Yeah, maybe the low's in, maybe it's not, but I won't be there when the lows formed. It'd be more a case for me of now watching the price. Well, I'm not even wouldn't. This isn't a stock that would even be on my radar at this point. It's not a stock on the motion trader radar because that key guidance system of the moving averages is negative. We've got declining moving averages, so that means it's not on my radar. Stocks on my radar during this phase when the moving averages are pointing in the right direction. So look, for now, I'd just be I'd be out of this stock.
Okay, Rajan. So let's have a look at MIN.
I've got a few of these, and it's got the building blocks of a trend. It's gone from below, it rallied into the moving averages, sideways, got back above. It's rising lows, rising moving averages. It's not getting carried away on the upside like some of the mining stocks. So it doesn't have the strongest of trends at this point. That's not to say it won't develop. At current levels, it could potentially be bought at current levels with, say, a 25% stop because you're buying into that broad momentum. Alternatively, it could be a case of even just saying, look, I just wait. Let's see if it breaks above Friday's high. I'll buy it rather than buy it now at 41.16. I'll buy it if it breaks to 43. So just paying that extra, couple of percent or whatever it may be to buying it at a new high. So just at least going with some momentum. But nonetheless, I think there's potential there. It's fallen from great heights. I think it's worthy of consideration. Wide trailing stop. For me, my stop will be just probably back down to about the 100-day moving average because it's only a relatively new entry for me. I'm not in there with a big profit, so I've got a closer initial stop. If it starts to run, I'll go to my wide trailing stop.
Okay. Last couple, I think, here, Jace. So let's look at Rio.
Yeah, look, a bit like what we discussed earlier with BHP, sideways for a few years. It's looking a little bit stronger than BHP at the moment in that it's gone from below to above. It's come back, traded sideways on the moving averages, got these rising lows, recently broken to a new high. I like the general structure. There's nothing to say that it can't still continue just to chop sideways for many more months, but it looks like it's starting to develop some momentum. Look, I've got a core position in this. And I'm happy holding it, collecting the dividends. Would I buy it at this point? I'm thinking I'd like to just, like I said with BHP, just watch it and see whether we just get a little bit of this sideways chop while the moving averages catch up, and then a break to a new high could be an entry point. So I can see a setup developing. I've got a bullish bias towards it. Probably not quite. I think there's enough there to say, there's a bullish signal because it has broken above that recent high and it's holding its gains. The moving averages are up. So it could be a buy now with a stop below the 100-day moving average, or we could watch it for a little bit longer and see whether it holds those recent gains, then breaks to a new highs. So depending on how you want to play the setup, there's definitely upside potential in it.
Okay, fantastic. We'll finish off with the one we looked at before, BGL. I think we looked at the one on the NASDAQ, Jace, and the one on the ASX looks a lot better.
We did too. Yes, I clicked on the wrong one. Yeah. No, this is a bit different. Actually, it's very different. So it's interesting. Is this? Let's see whether this works. It looks like a big bullish wedge. So you can see how the price actions compressed into this wedge, and now it's broken to the upside. So there's a bullish pattern there. That's an old school technical pattern. It's gone from below declining moving averages, above the averages are about to cross. It's So look, it starts to stack up. I wonder, it's like it might be a fraction early for me because moving averages haven't crossed, and then I wonder, like, do we then get some sideways consolidation? It could be bought at current levels with, say, a 20% stop. I'd be inclined to give it a little bit longer, but it could be bought at current levels with a 20% stop. I do wonder, though, it's a gold stock and it's been a bit of a struggler. You look at what other gold stocks have done, and this clearly hasn't been doing the same thing. So there must be some underlying issues. There must have been at least some underlying issues with the company. I'd probably rather go with some of the stronger stocks, but nonetheless, there is a chart structure there, which is where risk can be managed around, and there's nothing to say that it hasn't been through like a period where they've worked through some issues and things are turning around, and things could continue to do well with the share price. So it's I think there's certainly something there to consider. It would be interesting to come back in the next few weeks and keep an eye on it.
Fantastic. We'll finish off with this comment here. Alan, thank you. He says one of the recommendations was STN. It's done well and up 35%. Now they're chasing capital. Is it illegal for a company to buy their own stock to bump up the price? Interesting.
Yeah, well, it has done well. I've got some of this myself. Look, I'm happy to stay with it. Trends up. I'm not sure of all the rules about who can do what. This is a trend I'm happy to stay on. I'm glad you're on it. That's good. Great to hear.
Yeah, and on that note, there's a lot of commentary there, which is great for today. There's a couple of things just to be wary of. We've gone through some great tickers from people, from our viewers, and they're just ideas. You just got to remember, this is a general advice only. We can't tell you to buy, sell, or hold, or any of these sort of things. It's more of an ideas, and we want to actually teach you how to find these stocks and learn how to be able to analyze these stocks yourself and make your own decisions. Remember that. So it's a very important thing. We're not just here to tell you what to buy or sell, right? I'm glad that over these last 2 years we've been able to educate a lot of people. We've got a lot of comments on how they've learned to be able to do it on their own, right? So that's what makes me very humble, but at the same time proud. And I've learned a lot myself, Jace. Don't forget, obviously, there's the offer. The code word is there, Macintosh. You can check out the description below. You can take advantage of that special 2-year anniversary gift offer that we're giving away at Self Wealth. Just as another note, look, there's a lot of commentary. I'm sad to have to say these sort of things, but there's a lot of bad actors out there, people, and I don't want to have to say it, but have a look at some of the comments below. Look, we don't give any advice, or we're not giving any commentary around crypto investments or any of this sort of stuff. I'll probably just remove these. So if you're seeing me and watching me, I'll be removing them after this show. We certainly don't condone anything around crypto trading, crypto investing, crypto accounts, and that stuff. We don't. Self Wealth doesn't deal with crypto, neither does Jason. So just be wary of that. Everyone who's legitimately here and trying to learn and educate themselves. So I have to end the show with that. It's been a great show. A lot of great ideas.
Yeah, Rog, that's been great. Good to be back after our week off, and hopefully it's been interesting for everyone.
Yeah. All right. So just remember, the offer will be valid also for over the month of October. So we'll be talking about this again next week, right? Same email. Remember, it is limited to the first 20 existing clients and the first 20 new clients. So you've got to be quick to to move on that as well, right? But otherwise, I'm looking forward to another great show next week. Thank you, everyone, and I'm sorry if we didn't get to all your questions or tickers. We'll be here again next week. Just jump in earlier, and we'll do our best. Thanks, everyone, and have a great week ahead. Bye-bye.